Hey, good night, everybody. Today is Wednesday, January 20th. This webinar today is going to be about how to trade gaps, gap up or gap down. So, I think if I click on notes, it'll click on everybody else's notes, right, as we go along. So I'm just going to read through some of them, and maybe I'll throw back to some of the charts as reference. What's up, Ola? How to trade gaps, that's the topic today. What is a gap? A gap is a change in price levels between the close and open of two consecutive trading days. So a gap is considered where if this stock closed at 187 and it opens down at 184, then obviously there's a 3-point gap. So there are two types of gaps. Obviously there's a gap down like in this case, and obviously when you're looking at a stock on a daily, this is the actual gap that you're looking at here. So this would be considered a gap down. And if you are looking at a stock that goes up from the close of the previous day, in this case this would be a gap up. So the question is, how do you trade the gaps, either gap up or gap down? So gaps can be broken down into two smaller groups. I'm just reading from the notes and then we'll go through some of them. Gap ups can be broken down into two smaller groups, a full gap and a partial gap. A full gap represents an open above the high of the previous trading day, and a partial gap represents an open under the previous but partial gap up represents an open under previous high of day. Okay, what do I mean by that? Let's go into a chart and then we can figure out that. Okay, in this case, you see this would be the low of day here on SPY. The fact that it gapped down underneath, this is called a full gap because it's under the low of yesterday. So this is a full gap down. Now if you look at, but this would be a full gap up in this case because it's over the high of the previous day. I'm looking for one that would give us a partial gap where it opens in between the close. We've been having a lot of full gaps here on SPY. Okay, and this, wow, I lost it. 1, 2, 3. Okay, this would be a partial gap here, because even though it gapped up from this close here at 194 to, let's say it opened at 194.21, 194.88, there was obviously a gap up situation here, but it did not break the high of the previous day, so that would be a partial gap up. And then obviously a full gap up is like what I showed you before, where it totally opens up completely under the low of the previous day. So that's the partial gap down and full gap down, and it works the same for a gap up, obviously. And we could just switch over to UVXY real quick and we'll get those, because obviously SPY did the complete opposite. So a complete gap up would be a open above. This would be considered still a partial gap up because it actually opened down here and it did not break over the high. So that would still be considered a partial. This is a partial here. A full gap up would be here. Actually this opened here and this was over the high of the previous day, so then this from this day to this day would be considered a full gap up. On a daily chart you can definitely see these a lot easier, where whenever there's a complete space between the trading day from before, then it's like a full gap up. Like over here there's a complete gap here, so that would be a full gap rather than a partial gap. But that's not really too important, it's just breaking down the meanings of what gaps are. And then gaps can be classified into 4 groups. You have breakaway gaps. Breakaway gaps occur at the end of a price pattern signal and it shows a new trend. So a breakaway gap would be considered like this doji down here. So it would be like the pattern in a candlestick world would be considered an abandoned baby down here, or or an evening star, and so this pattern over here would be considered a breakaway gap, where it broke away down to the downside and then broke back to the upside here. So that's a breakaway gap. An exhaustion gap happens near the end of a price pattern and signals a final attempt to hit a new high or low. An exhaustion gap is when there's a gap that pushes up with no volume and seems to have no strength whatsoever in it. Sometimes you'll see exhaustion gaps where the price just totally goes up, kind of like DWTI did today, where it just totally full gap. Exhaustion gap would be where there's like a final burst of energy, and how would you know if it's an exhaustion gap or a continuation gap? Obviously, the next day's candle opening would show that. I'm just going over the notes right now, MK, so I'm not sure if you're how it would work. So, okay. I'll switch over from screens. I'll read the notes and then I'll switch over to screen share. Maybe that'll help you, okay? Okay. So, common gaps are simply represented just regular gap patterns. Like this is a common gap. This is actually like a continuation gap where the price action keep moving up, above, and above. And so the gap is considered a continuation gap because it's in the same direction of the trend and doesn't show a breakaway or a trend reversal or a price pattern difference or a signal or anything. So it's just considered a price a common gap. Continuation gap is like the same. They're all just names for things, just like how I always tell you guys about candlesticks and the names and stuff that they are. Sorry. Yes, Kate, you can switch over to notes anytime. It really doesn't bother me on my end. So these are the continuation gaps, and as far as the names go, I mean the breakaway gaps, price pattern changing gaps, exhaustion gaps, common gaps, continuation gaps. These are all just names for different types of gaps. But as you all know that the names really doesn't matter as long as you know what you're looking for. Then that's all that really matters. So. The gaps in 4 groups: breakaway, exhaustion, coming gaps, and continuation gaps. Alright, so that was my little got milk joke there. Got fill. See it? Haha. So, a fill. How do you know if your gap up or gap down is going... See, thank you, Michael. Michael laughed. How do you know if your gap is going to fill or not fill? Okay, so this is very important, right? Because there's a lot of people that question, hey, how do I know that my gap up or my gap down is going to fill or not? And you really want to understand what causes a gap and what causes it to fill or not fill. And take for instance... this one this morning, ZFGN was already gapping up, obviously. I think was phase 3, met primary endpoints, am I right? And so the thing with this stock here is this morning in pre-market it gapped up and it already filled its gap pre-market. Not the complete gap, because it never needs to actually fill a complete gap in any stock. People like to see nice clean charts and nice clean patterns, so they always say gaps have to be filled. Gaps don't have to be filled. That's just something people like to say. Do they often get filled? Yes. But do they have to be filled? No. So in this case on ZFGN, stock pushed up already. If this whole move was shifted over to actually about this time of the morning, then you would have still seen the same pullback over here from the sell-off, and then you would have probably still seen this type of a move over here. So this entire gap was kind of already filled pre-market, and that's why you got the push right out of the gate. Exuberant buying or selling. How do you know that a gap is going to be filled? If it's exuberant buying or selling. So in this case it was exuberant buying, and it already kind of filled the gap. I should do one that's let's do win. Okay. This win should be one. Okay. Okay. CN. What was that? GNC. Let's try that one. I should have made a little list of good ones. Okay. Yeah. This was a perfect gap fill here. Okay. This gap fill. How do you know when something's going to be filling the gap? Okay, when you first of all, when something gaps up, right? What you're looking for in the gap up, you're looking for a couple things. You're looking for volume. Is there volume here pre-market? No. Is it a sketchy looking chart? Yes. Is it gapping up too much? It closed at 23.60, somewhere around there, and the stock is sitting at $27. That's a $4 gap on a stock that usually has little range. I mean, like you get ranges, maybe a point range or something. So the gap obviously was too much already. To the gap up, I'm saying, was already too much. So what you're looking at is you're looking at the no volume gap up. A no volume gap up would be like an exuberant buying, and it would obviously fill because there's no strength into this move here. There are no real buyers. There's no real support here. There's no real anything going on its entire move. So something like this, when you look at it right off the bat, you can say, hey, I'm gonna just short this right off the bat. And if it pops it open, then you're looking for it to pop up to this area here at the high, and that's pretty much all she should not go past that. And even if it does, you just wait a little bit, because there's no real reason for this to gap up and stay up there with no volume. I mean, the volume was really obviously low, so this would be a gap that had to be filled. No technical reason. How do you know that a gap is going to be filled? No technical resistance or support areas. In this case, it's the same thing. There was no technical resistance or support areas because the way that the chart played off over here, it just there was too much ups and downs with no areas to form any technical supports or resistances. Nowhere. There were no moving average here. There was nothing here. This chart was gonna come back to the 50 here, and then it was gonna do something, and that's the only support that it had from here to wherever it went. The only support here was the 50, and so the chart was just kind of telling you that I'm gonna come back to a major support, or I'm even gonna come back to an area where the high was of the, not the high, but the obvious area of support was on the previous day. And that's pretty much what you're dealing with. So what you're dealing with is this chart kind of told you from the close of this day that, hey, this is my range here. This is a fluff gap, and I'm going to come back into that range, and then I'll do something. So if you, no, I don't use the 100. So if you looked at this chart here, you would see no resistance, you would see no volume, and you would see an exuberant buying for no reason, and that's your gap up. That's your gap up fill situation. Gap up, no. How do you know when it's not going to fill? What would be a good indicator? Okay, you can ask questions. What would be a good indicator to take a starter position in this situation? A good indicator, as soon as you get up in the morning, you see a gap up that has no volume. I would suggest you, first of all, you look at a few days back maybe. And if you, without looking at this area here altogether, as soon as you look back in this chart, you're gonna see a few areas, and just saying, I'm not saying that it would have, but just from looking at it, you're seeing, okay, this area here was obviously like a choppy area, so that's usually like an area of resistance or support. This over here is not a support or resistance area, so this entire area here, if it ever did get up, would be a major area of resistance. Obviously the chart did not get up there, so you don't really wanna, obviously you don't really anticipate it going all the way up to 30 from 20 something. So you choose this area here as resistance, and that's kind of where it was at there. That would just give you a whole inclination that obviously that chart's not working out for you. If you did the candlestick patterns, obviously, as Brenda pointed out, that's a bearish engulfing right there. That's a bearish engulfing right here, and that would obviously give you the signal to short it pre-market. So if you Michael, you shorted risking the pre-market highs, and that's it. So Michael shorted 26.40 26.40. So did you wait for open? You got the pop? Um, and then you shorted? Yeah, okay. So Michael waited for open and then got into this one. Even if you traded this pre-market, once you got this bullish, this bearish engulfing over here and the next price gap down, because that price actually opened here and then popped up over here. Once you get the gap down on it, that's your signal right there. That's your short signal in any candlestick world anyways. So even if you put it on a 1 minute, then you could even see how much more sketchy it was as far as the gap up goes. It was just really sketchy. What did you have here as far as signals? I mean, you had shooting star up there, which was just, I mean, look at this volume though, guys. If you even referenced it to the volume of previous days, on a day when a stock's gapping up this much, it should have more volume than this area over here. It should have more volume than this. So, not less volume. The volume should be increasing as the price is increasing, not the volume decreasing like the way that it is. So, it just gives you a first sight inclination that the stock is not strong at all. So a stock gapping up, stock gapping up, you wait for the pop and you risk the top over here. So, and that's pretty much how you would work that one. Let's get back into it though. How do you know that there would be no fill, a continuation gap up? Okay, I would have to look for a continuation gap up, and then I can okay, this would be a continuation gap down. I can do that. Okay, so we can just do that one. Let me go back to 15 and about a few days back. Okay, so this stock was gapping down here, same stock actually. I'm switching back to the screen sharing for those that are on their mobile or their iPads. They can't really switch back and forth. Okay. Where was it? What was I looking at? Okay, so let's just take this gap down here for instance. Stock gapping down. Obviously it was just no volume. You would think that it would fill, but it was a continuation on a downtrend. So the possibility of a fill was unlikely, because the stock was already on a downtrend. So it would be a continuation gap fill to the downside. It's kind of, man, it's kind of hard to sometimes explain these in a proper way. How do you know when it's gonna fill or not? The basic gist, honestly, is if it looks fishy, if it looks sketchy, if there's no volume, that's when you know that a gap down or gap up is really just gonna be filled. When it looks choppy, when it's not continuous, when it's not strong, when there's no pattern, when there's no actual resistance or support being held. If this stock came back into this range over here, right? When this came here and it popped up over, if this stock had played around here a little bit, bounced back and forth, I would say that there is a possibility that it's going to hold strength from this area here and push up, right? But it didn't. What it did was it came into this range here, back from this previous day here into this range here. Instead of bouncing around, it just kind of sold off right into it. So it's not really a strong gap up. Obviously, yes, if there's a weak catalyst, if there's some kind of fluff PR that was put out or something, then a gap up usually fades right into it. Also, if there is if there is a gap up like not today, the day before yesterday, right? That was when everything gapped up, or it wasn't today when everything gapped up. It was yesterday, right? Okay, so everything was gapping up on this day, the previous day, when obviously when the market was popping, the futures were green, and everything gapped up on this day, right? So what happens when a day that the market itself gaps up, you'll find that a lot of other stocks also that moves with the market, that they gap up with it. So in that case, those stocks usually fill because they only gapped up because the market itself gapped up. So on a day when you find like if just saying if you wake up tomorrow and the futures are 300 points, you'll see a lot of stocks gapping up. And what's gonna happen with a lot of those stocks that are gapping up is they're gonna, especially um, if they gap up nice, they're gonna pop, and then they're just gonna fade right back. This would have been the same day, but blue isn't really a good inclination of that in that case because it just didn't work out. Okay, CMG would have worked good in this case here. Obviously, the market had given it a reason to gap up, and so when the stock gapped up, this move here was just purely based off the fact that the market itself was gapping up, not that there was anything different on the stock itself. So when the market popped up, then it just sold right into it because there was no real structure for the company itself gapping up, unless that was the day when no, it wasn't. And there's no real structure for the fill. In this case, look at this one, the gap down here, and this totally filled right up to it, and because obviously this came down because the market itself was down. So in a case like that, then you see how it's just easily filled in the opposite direction, obviously, because this was just kind of a low. Look at the volume, right? Remember how we did the gap up in that GNC one? This would be the same situation with CMG, just on the reverse, where the volume was really bad. So even though it sold off on low volume, the possibility of it filling the gap was very likely. So I guess that would should be a good example right there of a low volume sell off type of pre-market, and you know that it has a possibility of pushing right out of the open because basically say they sold, I don't know, 100,000 shares into this range over here. These people over here, when it opens, they're gonna buy up 2 million shares because it's just so much cheaper now than it was. So it's just a buying opportunity really on a sell-off with weak volume like that. Unless it's bad news, then obviously it's different, but the volume would have been stronger to support that. So in this case, with a low volume sell-off, you expect a fill. And in this case, the same situation here, where it was kind of a low volume gap up anyway, so you expect a fill. Let me get back into the notes. No fill, breakaway gaps. Okay. Oh, okay. I'm almost done with the notes already. They just seemed a lot longer when I was writing it, huh? Okay. Asterisk on this one. Okay. When a gap is filled the same day, it's called a fade gap. It happens when when FDA news or something, for example, or earnings report. If it was a good earnings report and it gapped up, and it fades off for the rest of the day. Maybe there was something wrong with some other filing or something in their earnings report. Maybe people saw something else. Yeah, okay, let me look at Netflix and I'll see if that one Netflix news totally faded off, but the market also had a big deal to do with that one, right? But let's look at Netflix. Okay, so the huge gap up and then totally sold off. It actually just pulled right into it. Um, how did this one? Hold on. I want to just check a couple days before, and it was not really. It was not bought into. I think this one was bought into a lot yesterday, and once the earnings came out, all these people decided to just sell into it. So they took their money and ran with it, and then once it started to sell off, capitulation just kind of kicked in, and then it came right down with it. This gap up strategy doesn't really work well with ETFs. It does to a certain point. ETFs are always obviously controlled by a lot of different factors. So it's what's up, Plane? So with the ETFs, it's just it's a totally different trading instrument where they totally move obviously with the market, like obviously UVXY XIV, or if they move with gold like JNUG JDST, or if they move with oil like USO DWTI, or biotechs like LABD or LABU. They have different compositions to it, so they move differently than a regular stock does, and they really don't follow all the characteristics of a gap up or gap down. They don't even follow rules of candlesticks. They kind of do their own thing sometimes. So if you wanna trade ETFs, you really have to know specific areas of supports more so, rather than just playing theory type plays, which gap up gap downs is it's like a theory type thing. Obviously it works, and there's a lot of people that survive basically on gap up gap down plays, but it's not the and when you play in ETFs, it's not really the kind of strategy you want to work with alone, because it just doesn't always fall into that format. I mean, even if you did one, for example, like today with, let's say today with UVXY, how did that work? Stock gap in up, and then it just went straight up. Did it fill partially and cause the push right at open? Possibly. Did it hit the 50 and cause the push right at open? Definitely, because it found support. So then the entire gap up could have been consolidated already here into the pre-market, and then it popped right at open. But you just should not put all your theory into a lot of ETFs plays. Just kind of play them alongside with what's going on with the commodity or whatever that they're associated with. um so anyways, a fade, it would be like the Netflix. That's like a total gap fill fade, and that would be Netflix there. And obviously the reason why Netflix came up, because the market obviously came up with it. If the market kept coming down, I would assume Netflix would have just kept coming down too, obviously, until it hit a solid area of support. But that would have been probably found on more so of a daily chart. But it did find area of support over here. But if the market kept coming down, it would have probably just come down with it. So the market direction obviously changed a lot of stocks coming into close. A stock whose price opens on a full gap down and begins to climb immediately is called a dead cat bounce. There were a few of those. I completely forgot the names of them. SRPT was not one, right? Where it did a dead cat bounce? Not really. This one came down, pulled more. Um, there were a lot of them that did dead cat bounces, but I can't really put my finger on it, like the names right now off the top of my head. I should have looked for one of those. Would have been great. But anyways, when a stock gaps down overnight, when a stock gaps down overnight, and obviously if it's let's say if it's a FDA approval that went bad or something like that, and so I'll do a little drawing. Maybe that'll help. So stock's trading in this range, it gaps down to here, and right at open it starts climbing up right there. This move here would be considered a dead cat bounce, where immediately as the open started, short started covering, and probably some buyers started coming in, and along with them both, it just suddenly started to come up slowly. So that's considered a dead cat bounce, as far as gap goes. And yeah, I guess it's still under the gap up, gap down theory, or a bracket, I would say. So that's just so how to trade gaps. Okay, let's get into that, and that should be like a smaller time frame. And let's do when was a good one. Okay, stock gapping down, pops it open, and you short it. Now, when a stock is gapping down, and this is something that I taught a long while ago as far as comparing a stock gap down or a stock gap up. This is something I did a long time ago as like in reference to like a runner, a racer, a sprint runner. But it'll work better off if I did one that was gapping up. It would show a little more relation with it. That DWTI did not do that. Which stock this morning gapped up and just kept going? Is there anyone that gapped up and kept going this morning? um, Damn. Wish there was one that gapped up. Well, that consolidated CFGN. I just looked at it there, but it consolidated, so it just totally negates the entire thing, because it just really wouldn't apply to the exact. Okay, let's do 1, 2, 3 days back. 3 days back on when. 1, 2, 2, 3. There was an obvious move here. Okay. So let's do this. Let's do this gap down on when. Here. And this is obviously some sort of a news or something. Okay. So this one would be a stock gapping up, even though whatever happened here, I'm not sure what it was. Doesn't really matter to me at this point. So stock gapping up, it needs to pull at open and find a base for you to go long. If it pops at open and gets exhausted, you need to short it. So in this case, the stock was gapping up. It pulled right at open. This first candle obviously pulled right at open. It opened here. It pulled down here. Then popped back here and closed and then opened up here. So the first candle pulled it open, found base. And the base in this case could have been the 50, or the base in this case could have been any one of this range of support over here, which obviously came back to play over there. So when a stock gaps up, it needs to breathe a little bit. It needs to relax a little bit. And so in this case, it's like a runner. A runner's, sprinting over here. And when it opens here, it needs to take a deep breath before it can make another move up. If when your runner over here pushes again for another sprint up, he'll eventually exhaust himself and it'll flop. So in a gap up situation, when your stock's gapping up, it needs to breathe first before it makes a move up. And if it pushes higher right out through the gap, you're looking for a short. Now where are you looking for this short possibility if it does push up right away out of the gate? In this case, for example, ignore this entire play here and let's just do the gap up scenario over here. In this case, if this stock came up here and immediately pushed out of the gate, your first area of interest to look for a short entry would be right there. Now if that area of interest failed, then you would surely have to go out to a wider area of interest, and it would put you in this range over here for any other type of resistance right there. So you'd have caught resistance from, obviously it was support over here, and it was also pre-market high over here. So in this case, if this stock here, I'll change it back to 5 minutes so you can see. I'll put it back, screen sharing. Okay, in this case over here, if this stock was gapping up and decided to pop right at open, you would look for the first short entry would be at the pre-market high. That would be your first area of entry. And obviously when you're trying to fish for an entry like that, you always do a smaller size. So you want to do like a quarter size right at that top right there, anticipating that it's going to hit the double top and then fail. Now if you see that it goes through there, obviously I'm filled, it's okay. You look back somewhere else because your theory is already in play. The stock is gapping up. It's pushing at open. Don't get stopped out or faked out in this position here. You are already foreseeing your money coming in. Once this stock starts moving up, it fills you fine. You got an early fill. You anticipated a double top here. It did not happen. It pushed through. If it's still going through, what you should be thinking about in your head is give me higher, because I want to short this. Because the more it goes up, the more it exhausts itself as it goes up, the harder it's going to come back down. So even if you do get filled here, a lot of people is going to get filled here and then put a stop right here. But in this case, if the stock gaps up, immediately out of the gate, it starts to push up. It's already in your favor. You are already 75% winning this trade already, even though it's past your entry position, because the fact that the stock gapped up and pushed right out of the open, you are already in the money, even though you're red. Why? Because the format is if your stock is gapping up and it pushes at open, how do you know it's not going to go to the moon? Because we're not in OTC land, first of all, and second of all, it's not. If you have to obviously check your charts, and you should always be looking at your charts in a wider area. But if you look back a few days, you'll know that it's not going to go to the moon, because they will have a lot of areas of resistances that you should be putting your entries in for another short entry. And once you start off with that quarter size, you're not scared of adding in that case, because your trade is already in hand. Your trade is already there. You should be looking for more up. What you want that stock to do is push as more as it can go, and then you try getting into your short positions once you start seeing either candle patterns that are working out or a stronger resistance on a wider time frame. So once your stock is gapping up and it pushes right out of the gate, you got to use a few references, and a lot of time pre-market high is a good one to start your entry as for a short position. And then if it pushes more past that, then just take a relax and don't get scared and don't get stopped out for 5 cents because it pushed over pre-market high. The more possibility is that the higher it's going, the more you're gonna make on the downside. Why would Win would not have been a good short? Oh, I can show you Win this morning, and I actually recorded a minute or two of Win, and since you just brought that up, JJ, I might as well play it for you this morning. And my Win trade this morning, really, stock was gapping down. I was looking for a push up. I was actually looking for a push up to this area. Is everybody hearing me properly? There's one trader asking me that the audio is coming in and out. Yeah, so Barry, it could just possibly be your system. If you want to just hit that red button up on the top and reload, that's fine. Okay, so the Win situation, I was looking for a bigger pop at open, and my morning idea on Win was clear and direct. I did not get quite a fill that I want, but I did record a live piece of Win here for you, and I can play that back for you. Let me try to see if I can find it. It should be in this file. Open recording. Okay, so I'm gonna double click on this. Okay, so today is Wednesday, so January 20th. I'm gonna try to record a live gap up, gap down situation trade. So obviously this is Win gapping down a couple points. So I'm watching it here for either a pop it open to short it or a pull to go long.
It was a little busy.
And being that it's hitting some resistance right there, I think that it's just gonna pull here. So I'm gonna start a short entry on Win. I'm trying to see if I get filled here at about 57.50. 25. Oh man. Okay, so I missed the whole thing already. Okay. Now my only hope here now is for it to pop back so I can re-enter the short position. So I'm gonna wait for a short cover, which should pop it up a little bit, and then I'm gonna start a short position. Okay. 50. The volume is up on it. Come on. And you can't hear the audio from the video, right? Damn it. Okay, so I got filled. Okay, that's fine.
Okay,
if you guys can't
57.
hear. Nothing, right?
Let me try to get 25. 10. Fine.
Okay.
I got 57.10
Not
on
a
the short
problem.
side on win.
I could probably upload it
And
into
now I'm
YouTube.
looking for
I
it to
figured this would
pull.
work, but it didn't. Anyways, the
Obviously,
short idea
the
was here
pop
on
was
win,
not enough
and I
for
did
me
get
to
a
get a
57.
decent fill, but 57.10.
I got a 57.10 fill.
So far, it's
You
obviously
can hear me
working.
talking there.
So let's see a little more pull back down to. I'm looking for about 55.5 or so. So let's see where it goes from here. This is obviously my first buy. And I'll be covering into any huge pulls. So if it pulls here right now,
Oh, I know what.
it's
I could
about
put my
56 and a
earpiece.
half,
Hold on, if I
I'll
put my
cover some
headpiece
of my
close to
position,
the speakers itself,
and
maybe
then
you can
I'll
hear.
add on
on.
pops. I already have an order in to cover some, so let's see what's up.
Vinny's looking MCHP. Gapped up on news. Vinny's kind of strong up here at 43. I know you want
So there's one more pull here.
Just be careful with it. I like to see it
Come
pop
on.
about right there. See that area? You take some here, have room to about 44. Okay? And you'll have a nice average of 43.50. Then you can fade it back. Alright?
Hold on, guys. I wasn't talking. I was actually trading here. I wasn't actually talking right there. I was already in the trade.
Solo
At
XIV
50,
here. JNUG stop.
57.10 was my short entry. Hold on.
This is what we want. I thought it was a nice short opportunity, 26.50. Don't know who picked it up, guys, but it gave me a 26.50 bill. I was suggesting that with room to add, and it's already pulling. So you're already $1 the money on that one. Here's the Tiffany pop.
So I'm about 50 cents in the money here.
Congratulations, Anthony. Please make sure you guys give me your entries. All right, there's the Tiffany now. There's the 63 I'm talking about. The higher this goes, the more this is going to pay, traders.
Okay, so I'm gonna take 50 cents off this one here
Want just copy
and cover some.
of the gap. All right,
Okay,
that's what it's
so
doing.
I covered some here at 56.50. So I made 60 cents on that. Now my stops.
Okay,
are
so that's
going
just
to
basically
be-
me walking
My
the
stops are
trade
gonna
down
be
a little bit. Yeah, this is a recording of my live
57
trade this morning, and the audio
area
obviously you
for
guys
now
can't
on
hear
the
it as
second
much.
half.
So I took the 57.10 short, and I
One trade at a time. Watch DDD. I like DDD, guys.
and I switched it over to the 1 minute because I was still in the trade, and then once I got down here, I
That
covered
looks
it for
pulling.
a full point,
Yeah,
and it was still coming down here. And
Okay,
that's
so
when
now
I was,
1 point
I was
in
out
the
of the
trade
trade
here,
on this
so
first green pop
It
back
was a
here.
pretty good pop and
Action. Right about here is when I covered on the first green candle that showed up here.
And
Wait for it,
I
and
think
that
pretty
was
much
my
gonna
cover.
be that's
right
my
there.
signal
And
there
I was
to
out.
get
Anyway,
hell
so the
out.
trade was, and I could X this
So
off now.
one
And my
little
kid
pull
was
here,
screaming
and
at
I'm
me.
gonna
I
get
didn't
out
have
of this
time
one.
to. There was no
Okay,
reason
so
to
I'm
get
all-
out of that trade at that when I did it this morning. When I got in 57.10 on the short over here, there was no reason for me to actually get out of the trade. I did honestly get out of the trade because I didn't feel like recording an entire 6 hours of what could have been a possibly long trade. Obviously, it was live. I didn't know how long it was gonna actually be. So I just honestly did my first cover was from 57.10 was at 56.50, and then my second cover was for like 1 point. It was actually a little more than 1 point. So yeah, I was just trying to record a live trade and show it back on how you would play a gap up, gap down. And what I was expecting on win was a little more pop right at open, and it didn't give me that. But once the trade started to fail right at open, I just got into the short position. Um, if this gap down pre-market, shouldn't it have gap filled? And why you didn't understand why I decided to short. Okay, if you do it on a smaller time frame, you'll see that the first candle did pop right at open. Now the pop itself does not have to be a huge pop. And do all gaps have to fill? No. All gaps don't have to fill. So what I was just looking for was for a pop at open, and I was actually looking for a pop more somewhere to like 58 area. But when I saw that the trade was already coming into play, I just initiated the short position right away, and I was risking into this range over here. And so obviously I could have held it for a lot more. When I did the trade at 57.10, it actually came all the way down to 52 something, but I just wanted to do 10 minutes of the trade and could have really just I do limit orders. Yeah, I do limit orders for pretty much all my trades. Okay, how do you play a gap up, gap down situation now? So in a gap down situation, when you want it to pop and then pull, obviously the pop does not have to be huge, right? It does not have to be a complete gap fill. I was looking for more of a pop here. That's why when I started recording, I was kind of slow on the trigger because I wasn't expecting it just to kind of pull. But once I saw the little pop, and I'm on a 5-minute now, but when I was trading, it was I was watching a smaller time frame. I expected more of a pop, so I was kind of just relaxed a little bit, waiting for a little bigger pop. But once I started to see the L2 was giving up a little bit, and it just wasn't looking like it was gonna pop more than that, then I just initiated on the short side. And I could have actually, obviously, wrote that down, especially with my strategy where it never actually came through back to 13. I could have wrote that down all the way. But for the sake of the video, I really just wanted to do like a 1-minute or 2-minute video. And it didn't happen that way, and I actually killed the trade for 1 point. And then I turned back this afternoon to look at it, and I was like, oh man, I missed out actually quite a lot of money on that trade just because I was recording this for the sake of tonight and not caring actually about the actual trade. What if it had crossed 13 or 50? If it had popped and gone through here, then I would look for a top end still. If the stock's gapping down and pops it open, I'd still be looking for a top end and then to short it. If it pulled it open, I would be looking for a long. So if it pulled more at open, I'd be looking for a long. If it popped it open, I'd be looking for a short. So if it popped it open, my first area of interest was right here, about where the 50 is, and that was my area of interest that I had in my head for a pop, and it didn't get that far. But once I saw the little pop it open and it just seemed like it just wasn't going anymore, I said, hey, I'm just gonna take the short. And then it actually did pull on me a little bit. I thought I missed the whole trade. Then I waited for a pop, and then it came back down. I could probably upload that on YouTube, but it's a noisy kind of trade. My daughter got up at the same time and kind of was screaming in my head. So it was really a crappy video all in all. But I was really trying to get a live trade going so you guys can actually see it, but it didn't work out to plan. My bad. It was a good thought, but it didn't work out to plan. But anyways, yeah, my phone was on, and so I was just it was a lot of noise. It was my fault. You know what? And the thing is, there was a live video. It's not like I could be like, oh, I recorded. You know, I'm gonna show you a trade of something else that I didn't play, or like a hindsight trade. Obviously, hindsight trading, I couldn't have two charts up and just show you two separate different things or whatever. So it was just one, and I picked this one. Happened to be this one this morning that I decided to hit the record button on, and I just wanted to showcase one trade at least that I can show you guys tonight. But it didn't really work out that well. It was a good thought though. All right. how do you play this? How do you play this according to when you want to get entries or exits? Let's say this stock's gap. Let's pick something else. Find me something else that was gapping down, gapping up this morning. Okay, this thing. Okay, fine. How would you play this? Two ways to play this, especially if you're looking at it at your pre-market. You're looking at the stock. You see all the fluff here. You're anticipating. Okay, in your mind, you're thinking, hey, I want the stock to gap fill, right? And so here's how to play this. Sometimes the pops happen so fast, or the dips happen so fast, where you don't seem like you can get a correct fill, right? So, and I'm sure that's a lot of people's problems. Here, how I solve this problem immediately. What I do is I put two orders in. One up here at $27, around right at the top there, and then one down here where I would see that it would come to support. Now, say I want 1,000 shares on this entire thing. So I'd put 250 shares up here in a limit order and just leave it there, and 250 shares in a limit order and leave it there. It would take me within the first couple minutes of the open. I'm not doing this to 10 different stocks where I have no control over anything. I'm doing this to the one that I'm focusing on right at open, right? So you put an order in here, especially if you're not fast with the trigger, or if you want to do market orders on something that has really wide spreads. You could really screw up a fill. So I like limit orders, so this is what I do. I put a small order in there for 250. I put a small order in there for 250. One short, one long. Whichever one gets filled, obviously, if it pops it open, that one's going to get filled. And if it pulls it open, this one's going to get filled. In this case, neither would have gotten filled because the pop was not enough. But knowing that all of this over here was going on, and once these candles came up pre-market, if I was actually looking at this one, I wasn't even looking at this one. No problem, G. If I wasn't looking at this one, I probably would have seen like that signal right there, but I was not looking at GNC. Obviously, there was a lot of stuff moving this morning, so focusing on one thing was really difficult. And I was trying to just focus on that win for the play. So if you were looking at this one, then fine. And blue was coming down this morning, but I don't think was it a big gap this morning. Blue stock gapping down, pops it open, you short it. The theory is the same. If it's gapping down, you want it to go the opposite way in order to short. If it's gapping down and it continues in the same way, you want to take it long. Now, how do you know how far should you let it go? How do you know how much should you give it? In this case over here, if you do moving averages, then you should have some moving averages as to pertaining to where you want that pop to be. Some trades you completely miss it, and that's okay. It's completely okay to miss a trade and rather than take a trade that's going bad on you. So in this case, like with blue, I would have missed it over here too, because this pop was just not enough for me. So this gapping down, stock pops it open and you short it. Yeah, in theory, hindsight, I'm looking at it. Yeah, that looks cool, right? But no, I would have never gotten this because I would have anticipated a pop that was quite a little bit more over here. And now on the other hand, if I was staring at this blue chart, literally just staring at it at open, I would play pure candles there, and I would see obviously a bearish harami there, and then the stock gaps down under it, and so I would have shorted it there in this case here. But that's purely based off candles. That has nothing to do with the gap up, gap down. In this case, in the gap up, gap down, this situation here was not perfect. It was not an ideal situation for a gap up or gap down, because the stock gapping down pops it open. You expect a bigger pop than that. At least it's such a no volume sell off here. You expect pretty much a complete full fill over here, but it didn't. So I would have never gotten into this trade because my entries would have been up here for a short. So it would have just never worked for me. So it's not a good candidate for a situation like that. Some stocks will work and some won't. Are you going to catch all of them? Definitely not. Okay, this one's good. Stock gapping up in the morning. It pops at open. So obviously the stock opened here and it pops right at open. That's your short right there. And if you put on a smaller time frame, let's see what the first exact candle did. Then we'll have a good idea. Depends really a lot on what size candles you use too, okay? What time frame you use. If you're using the the 1 minute, 5 minute. It makes a big difference in what you consider a pop or a pull, because that candle from open to close could be a green or a red, depends on the time frame that you're using. Okay, so in this case here, if you're looking at it here, this would have actually pulled it open on a 1 minute, and then you played the long, look for a top in, and then short it. So in this small little time frame here, I don't really know what range you play in or what you're looking to accomplish. It would have been a pull it open, then take it long. And obviously if you switch this exact trade to a 5-minute candle, you would see a completely different trade where it's obviously a pop it open and pull for the short. So you have to kind of stick with a time frame also, and decide. Like I play opens with a 5-minute most of the times, 99% of the time. Sometimes if I have it on a 1 minute, it's because I'm just trying to nail something. But other than that, for the most case, I'm sticking with the 5-minute open, and then I'll switch it to 15 during the day. But in this case over here, if I was playing a 5-minute, you can play it a couple ways, where pop it open and then short it. You could have played this a ton of different ways. You could have played a flag breakout here and just go long off the breakout, and then short the top off this double top area over here. So in this case, there would have been about 5 different ways to trade this little scenario right here. Flag breakout, stock gapping up, pops it open, use the 50 as support, hanging man, gap down, that's a short signal, double top, that's a short signal, double bottom, that's a long signal. So there's a ton of different ways to play this little scenario right here. But as far as a gap up, gap down scenario goes, if a stock's gapping up and pulls it open, and obviously it found base right there, then go long, and then hit for top, and then short it. Now on the daily, I really prefer to use the gap scenarios on daily charts rather than well, it really works really good for swing trades is what I'm saying. Not that it doesn't work for day trades, don't get me wrong. I play a lot of morning plays like that. But if you really want to focus on a swing trade, it works the exact same way as with the daily intraday trades. It's just on a bigger time frame, where if you get a gap up, you wait for a pullback, and then you take a trade long, like for a swing or something like that. But as far as the intraday goes, if the stock, basic idea is if a stock's gapping up, you want to look for a top area, and give me one that was or maybe a couple that was on AJ's list this morning. I'm gonna go through them, and then we can do that, and that way I can see, I can kind of see what. Okay, DDD, stock gapping down, pop it open, short it. Okay. So obviously this one would have worked really good in that formation. Stock gapping down. This is a complete gap fill because there's nothing here. There's no life to this trade right here. The stock gapping down, complete gap fill. So you're looking for a pop it open. You're obviously looking for an area. In my case would have been the moving average. In AJ's case, I'm sure he's looking at just resistance or support areas because he doesn't use moving averages. So they both would have worked into basically the same range as for the short position. So I'm sure that's probably what he saw there. If it pulled it open, I'm sure he was looking for maybe low of this pre-market area here to be support, or if it came right under 5 to go for a long shot. So that would have worked perfect. Stock gapping down, pop it open, short it. So that's textbook. ZFGN, we kind of did that. It gap filled pretty much pre-market anyways, and I saw that pre-market, that's why I went long ZFGN. Cree, was that on the list this morning? Cree, stock gapping up, it pulled at open. This is a good one. Stock gapping up, it pulled at open. So what the stock did here now, the stock was gapping up already. So this runner over here, what he did was, he was running, right? So before he did another sprint, what he did was he took a deep breath, and then he went for it. So if he had just gone for it right off the bat, he would have failed. But what he did was he took a deep breath, and then he went for it. Now the base of this over here, this one, support-wise, I mean, I don't know if you can see that there, but after hours there was a pin there, and there was a pin there. So that's basically two areas that you should be looking at. If you pin that there and you pin that there, you'll see that I'm sure it'll come back into play for this entire trade for throughout the day. Let's see how much those two lines had affected this trade. Well, obviously it was support resistance throughout the entire day, but that top and that bottom right there after hours would have given you a good inclination of your zones. So if this stock would have popped it open, you would have looked for a short around that area right there, and then you would have been adding over here. And if it pulled it open, you would have been looking for this area right here, because it already gave you a range. This stock already said yesterday after hours, the stock already said from the first instinct, whatever this was, news, earnings report, whatever it was, the stock already gave you the idea of, hey, this is my top range, this is my bottom range. So that's it. So that's what I want to do. So when the stock came into play already, this was a simple read. Either it was going to pop up to this area and then short it, or it was going to come down to this area and then go long. So this one was a really good one, and I really gotta just look at these a little bit more because things are just too easy. IBM, stock gapping down. Okay, give me 1 second, try to focus this up a little bit. Okay, stock gapping down, it pulled right at open. This candle was a pull right at open, then just went long. And if you watch this entire candle here, it's a total bullish engulfing. So if you're into candles, that was your go signal right there too. So stock gapping down, pull it open, go long. Now, how did he find a base for it? If you look back a few days, we'll have a reason for it. No, am I in the same stock here? 122? Yeah, right? Okay. Yeah, I have no idea how we found a base for that. It's AJ. I have no idea. Did he have like numbers for that? Like real numbers? Because I have no idea. Boss, how'd you find a bottom for that thing? Like a real number figure, because I don't know, if it goes to 115, goes long. Okay, so he was just averaging if it was gonna pull down, because on the charts there's like no real support there. So he was just giving you a range that if it pulls a couple more points. And I'm sure when you're looking at what you want to have in your head is, like, let's say this is 129 to, let's say 120. Okay, so this is 9 points down already, right? When you average in, this is like the span of a worst case scenario for this stock, whatever it was the earnings, right? So whatever this was here was like a worst case scenario for this range here. So 9 points would have been its worst case scenario. So what you want to do is you want to give something like that an extra couple points just in case it decided that it wanted to pull down more. And that's why I'm thinking that he said 115, just because it was already kind of worst case scenario over here as far as their earnings went. So even if the stock was to pull a little bit more, it would have given you a good opportunity to go long. But the any pull at open would have given you a reason to go long here because the stock was already gapping down. To find an actual range of support, there really isn't one. If you look at this daily chart, there isn't really a range. I mean, you'd have to go way far out to find a range, and that's just being silly because it's just too far out. So if a stock's gapping down already and it's 9 points down basically, you want to, if it pulls a little bit, you want to go long on it, and you have to test it. This is not like, I see a lot of traders, they want to get into a trade, and even when they are fishing for a stock, if they want 1,000 shares, they go straight 1,000 shares. And especially if you're fishing, if you're playing gap up, gap downs, it's not an exact science. Sometimes you'll find a stock that, like a gap down, and then it pops it open, and it will find a direct penny for penny area with a double top, and it'll pull right off of it, and it'll be like the ultimate perfect trade. And it happens, it does happen a lot. But when you find a stock that's within like within this range over here, once it pulls, you kind of have to feel it out a little bit.
I mean, and in this case, he was calling what 115 on this to go long, and if you played it on the 1 minute candles, you would have had to find a different reason to go long. Obviously, the reason to go long was right there, but you would have to have a different reason to go long. Now he's saying if it popped to 122 area, he would scale in short, and this would be the 122 area, would have been right about here. Yeah. Okay, so he was looking into this range here. If it came into this range here, you short it. And if it pulled down to a further amount, which would be an overextended, over-exhausted sell-off, and then you would go long because there'll be fresh buyers coming in to pick up those shares, that price. Tiffany was also on the playlist. Stock gapping down. It was really fluffy here. Nothing really going on. If it pops it open shorted, I'm sure that's what his thing was. It's pretty much gap up, gap downs are the same theory forever. It's not going to change. If it's gapping down and it pops, you short it. If it's gapping down and it pulls, you long it. You can write that down in a sticky note and stick it on your computer. If it's gapping up and it pops more, you short it. If it's gapping up and it pulls to an area, fills the gap, or partial fill the gap to an area of support, you go long. So that's just the way that gap up, gap down works. How do you know when it's gonna fill? It's gonna fill if it's a weak play, if it's low volume, if it's a fluff PR, it's gonna fill. If it's overextended, if you see a $5 stock and it gaps up $40, it's gonna come down and fill. So. And if how do you know that it's not possibly gonna fill? When it's really good news, when it's like a phase 3, some kind of really strong type of thing, or if they have really good earnings, if the stock was in a strong continuation pattern, stuff like that. So you look at different factors when you're considering, hey, just on the outlook, do I think the stock's gonna pull, or do I think the stock's gonna pop? And so you have to go back a few days and you see what the stock's been trading at. Now, if you find a stock right up into earnings, okay, for example, just say these candles represented 1 day, okay? Just say these candles represented 1 day. So, and earnings is right up here, right? So say this was earnings, then they're buying up into earnings here. I don't care how good their earnings are. When their earnings come out, what's going to happen is you're going to see this, and then you're going to see this. Why? Because people get so confused. Why is it that my earnings were so good? I went long up here and I got up and it's all the way down here. Why? Because what it is this was bought up into. So what you want to do into trade sometimes when, or this could happen the same as if they have an FDA approval and it was bought up into. If my company is having an FDA approval, well, not an FDA approval, but they're having a meeting, or they're having something where they're meeting up for something, and you know that there's an endpoint meeting coming up soon, people buy into that, but they buy into data, and so your thing comes out where that day it's like, oh yeah, well, we met it and we have 100% success rate, and then you go long right up at the top here thinking, oh, this stock's going to, up here the next day, and instead you wake up and it's down here. Why? It's because all these guys over here, this is what they were waiting on here. That's all they were waiting on here, and they got out. And that's similar what happened with the Netflix, obviously. It wasn't bought up so much into. I think Netflix was just more like a one-day buy into, but it was definitely the same thing where they bought up into it. I remember when we were trading it during the day, there were tons and tons, and I was calling out the MMs on blocks and everything, and because they were buying up into it. So even though that their earnings was good and they beat, any pop would have been short-lived because they would be selling into it. And so when you are playing a gap up or gap down scenario, you have to look a couple days back too. Just don't especially if you're looking at this stuff for yourself, you got up in the morning and you see a stock that's really like, it was trading nice and flat or whatever, up and down, and then it like gaps up like that, And so you're thinking up here now, what do I do right at open? This is like opening bell. So you're thinking now, what do I do? What you do is you look back previous days, and if this was something that was being brought up into or something leading up to this event, then obviously look for any pop to be short-lived and just short it, you know? If it was something that was beaten down or something totally opposite from this, then look for the opposite reaction. But you should always be looking at a couple days ahead, or just quickly switch back to your daily chart. It takes you 2 seconds to look at a daily chart and see what trend the stock was in, and how do you think the stock's going to react to the gap up or gap down situation. When a stock's gapping up like excessively, like DWTI or something, for example, but that one's hard to really bring up because it's an ETF and oil's just doing its own thing. But when a stock's gapping up excessively on lower volume, you definitely want to be looking at something like that to short. Or when it's gapping down excessively on lower volume, looking for it to fill. So I'm hoping this kinda helps you a little bit as far as the gap up, gap down goes. But the basic idea is if a stock is gapping up and pops at open, you want to short it. If a stock is gapping up and pulls at open, you want to go long. Obviously, both areas for entries should be at a resistance or support areas. And similarly, if a stock is gapping down and pulls furthermore, you want to go long. And if a stock is gapping down and pops, you want to go short. And that's just something as a trader you should know off the top of your head, how to play gap up, gap downs. What you should do in the morning is, if you want to pick a gap up or a gap down, pick 1 or 2 charts and find the area where you want to put a long position in or a short position in. Even if it's 100 shares at a time, one at the top, one at the bottom, especially if you're not fast enough, or if you really have a definite area that you think that a stock should be at, and put 2 orders in. And then if you're not fast enough on your fingers to get that fill, because sometimes the stock will open up and it go and then it pull right back down. And then a lot of people will go, how did you get that fill? Because I had an order up there already, just waiting for it. So, like, I'm not waiting for that 1 second where it goes like this and comes right back down. Because you find a lot of stocks that do that, like Blue or something, for example, or VRX or something like that. They do stuff like that where it just pops. And how do you get filled up there so quickly on a stock like that? Well, you just have to be quick, or have an order there already. And most of the times I have an order in if I am playing a particular stock for a gap up, gap down scenario. If I'm playing a particular stock for that, a lot of times I do have an entry in on a short side and a long side, and just have them there. And if they get filled on the either side, well, I'm already green on that trade, theoretically, because it already did the direction that I wanted it to. And which makes a lot of sense, because if it pulls, whatever, you just X out the other one, and if it pops, then you just X out the other one. So it's not like they're both going to get filled instantly. And so not like you're going to get into a trade in a box situation or anything. It's just not likely. And then you kind of have a situation where you're already in the green. Remember, if a stock is gapping up and it pops it open and you take a short position, don't get scared, because you're already in the money mentally. Think about it. If the stock is gapping up and pushes it open and it hits your entry and you are in the trade already and it still pushes more, just keep in mind that you're already a winner on this trade, because theoretically this trade's gonna work. You just have to find a different top or different resistance area. And similarly, if it's pulling down and if it's gapping down and it pulls it open and you catch an entry, just hang on to it and make sure that it's not your full size entry anyways. So what you do is, if you're quarter size and then you find the bottom finally, you have 3/4 more size to add. So if you started at $10 and the stock pulls to $9, you have 3/4 size to add. When you buy that, your average is going to be $9.25. So it's like, that's why you always start off with a smaller size, because that way you can control your trade instead of your trade controlling you. Because if you did 1,000 shares at 10 and your stock pulls to 9, now you're $1,000 down. So if you did 250 and it pulls to 9, you're only down 250, and once you add at that your 925 average, now you're golden. So you have to really manage your entries as far as how much shares you want to get and how much shares you should be putting in right away. If somebody wants a 5,000 share on any stock, obviously they should have ways of getting that, not just buy 5,000 at any point. Because the person that tells me, hey, I just bought 5,000 shares of this stock at this price, and that's my only order, it just makes me right off the bat say you really don't know what you're doing, because you're basically telling me whatever price you bought it at, that you are 100% guaranteeing me that that's the area that it's going to be at. That you're basically telling me without a doubt that's the area that it's going to be at, and that's just crazy talk right there. Not in trading. There's no such things as a guarantee. There's none. You can play flags, you can play MA crosses, you can play gap up, gap downs, you can play anything that you want to play, any formation that you want to play. There is no guarantee. So make sure that you're scaling into positions properly and scaling out of positions too. Like, so just say that you took this position here. Okay, forget the gap up scenario, but just in a longer term, say you took this position here based off of this flag and you took an entry here. Your first initial stop is over here, and then your first add is when it gets over a major moving average, which would be about here. And then if you wanted another add, it would be above this area of resistance, which would always be all the way here, but still you have to get through area of resistance. So your third add would be here, and just say that was your 3 adds or your 3 buys or whatever there. Your first area of sell is right into this area over here, which would come into here, and then you would hold some, and probably stops right over here, because that should be your new support there. And then you would ride it out. Once you get your bearish signals, then you're out. But you never, if you wanted 5,000 shares here, you never say, I want 5,000 share at this exact penny and expect it to work instantly. That's just not how it's going to work. And if you do that for more than 2 or 3 times, eventually you'll find yourself working at McDonald's. So just don't do it. So I'm hoping that the gap up thing was a little more explained. Maybe you understand a little bit more. Maybe I confused the hell out of you. I'm not sure, but definitely email me if you want me to send you some examples, or we can go through some more stuff, and try to get you to understand this. Because playing gap up, gap downs is a very, very profitable way of trading, and you can literally be done trading within the first like 10-15 minutes of the day if you find the proper ones. Now obviously with the list that we get from the pre-market notes, there are 10 of them on there, and they're most likely gap up, gap down scenarios. They could include FDA approvals or not approvals, stuff like that, earnings, stuff like that. But to pick the one that's perfect, that's just purely based on, if you look at all 10 of them, and maybe you can pick out a few that could give you the best ranges, or maybe you can pick out a few that has the most support or resistance areas. If you look back a few days, maybe you can pick out the one that has the least volume pre-market and play those. So you kind of have to decipher out of the 10. You can't play 10 gap up, gap down situations at the same time, by the way. If you try that, you're going to blow up. You can't play all 10. So you got to pick 1 or 2 or just one and play it. And you're going to, and now the thing is that you got to focus. Just like I was focused on that win trade, there was so many other things going on around me. So many other trades that were flying. And I had to sit in that one, would just watch it go tick by tick, and just made 1 point on it. And meanwhile, I took it off early. It was like a 5-point trade. But the fact is that I had to sit there, watch all my scanners flying all over the place, and I just had to stare at that one because I was already committed to that trade. So if you want to, especially when the market opens, if you want to be jumping around, you're gonna lose your head, and you're gonna lose money quickly. So with the gap up, gap down thing, just pick one or two out of the list. Narrow them down to, okay, well, this one's gapping up exuberantly. Fine, I'll play that one. This one had good earnings. Fine, I'll play that one. This one had FDA news. Fine, I'll play that one. But choose one and set up your screen. And if you need the help from the lines like I do, then plug them in. Is it gonna hurt you to put a line here so that you could say, hey, if it gets close to that line, then I want it? Or if you want to plug a line in there, hey, if it gets close to that line, I want it. If that's not gonna make you a horrible trader to put lines in there. Especially if you're a new trader and you find, well, okay, maybe if I look back on a 15-minute chart for a couple days, I can see, well, there's an area of support, of resistance or support there, and then this would be a low of day, would be an area of support here or resistance, wherever the case is. So now when you enter this day trading over here, you already have two areas where, hey, look, I like this area here as support, or I like this area of resistance, without having to go back 2 days real quick. You already have them plugged in. So with the gap up, gap down situation, you want to have as much factors as you possibly could to help you make a quicker decision on where you should get in and where you should get out. So once your trade's working the way that you want it to, in the gap up, gap down situation, you need to assess your risk, obviously, and let it work for you. Because if you follow the first rule of gap up, gap downs, the most likely the trade's gonna go your way. You just have to be patient with it. And that's pretty much it. Even when AJ calls the tops or the bottoms, those are ranges. He's not saying, sometimes it hits right to the penny, and sometimes I do it too, and there's a lot of other traders out there that do it. And that happens because you can find an exact peak or an exact point, and that's great. And it happens a lot, but when he gives you a number, it's merely a range of, hey, you should be scaling in short into that range, or you should be going long into that range, or you should be looking for support or resistance into that range. Not necessarily where it says, here, click this buy button here, or click this sell button here. It just doesn't work like that. Trading doesn't work like that. If you want to do that, get an algo program or hire somebody to click it for you. But it just doesn't work like that. So just make sure that you assess your risk and make your own judgments and learn and read and study and watch videos and follow candlesticks and trends and all this stuff so that you can try to make some of these decisions on your own. That's why you're here tonight, right? You're here tonight just not to talk to me, but you're here to learn something so that you can better yourself. So in the long run, you can call gap up, gap downs, you can see them, and you can find them, and you can play them, you can nail them. And that's pretty much that. So hopefully this was beneficial to you guys. I'm going to stop recording, and that way you guys can ask any other questions, and we can wrap it up after.